The Bank of England gave some relief to millions of borrowers today, cutting interest rates by 0.25%, the first reduction since June. But don't expect more to follow just yet. The Governor, Andrew Bailey, said the bank is keeping a close eye on inflation and the budget may have kept it higher than it would otherwise have been. Our economics editor, Joel Hills, reports.
One at the top.
It's a cut, and Holly Stinson is hoping there'll be more to come. Her fixed-rate mortgage deal expires next month. Happily, she's a broker. Unhappily, her monthly repayments are still set to rise by at least £300 a month.
I'm probably going to fix my interest rate in again for another 2 years, with the expectation that hopefully in 2 years' time it will come down again. But I'm very aware that I'm part of the people who bought when the interest rates were abnormally low.
Ask a central banker what happens next to interest rates and they'll tell you they follow the evidence. But the signals are clear.
I think the path will be downwards from here. It will probably be gradual. We've used this word gradual because there are a lot of risks out there still, both globally and domestically. We've got to see how those evolve. But I'm, very optimistic on this. I think we're on a downward path.
3 years ago, the bank began increasing interest rates to contain soaring inflation. Prices have since stabilised, and in August, the bank cut for the first time. Today, they cut again to 4.75%, and the markets are betting there'll be 2 further interest rate cuts before the end of next year. But just over a week ago, before the budget and the US election, investors had 3 cuts priced in, bringing bank rate down to 4%. The bank has looked at the budget and decided it is a bit inflationary. How quickly interest rates fall from now will depend to an extent on how businesses respond to the extra costs they face as a result of the Chancellor's decision to increase national insurance in particular. That has implications for prices, for pay and for jobs. But there's another risk on the horizon too, and it's one the bank is much less keen to talk about.
Outside of love and religion, it's the most beautiful word there is. Tariff!
Donald Trump swept to power on a pledge to impose higher taxes on imported goods, which he claims will create jobs and revive heavy industry in the United States. But America First has implications for Made in China and Made in Britain.
Do you worry about the prospect of a trade war?
Well, I worry about the fragmentation of the world economy.
Is that the same thing?
Well, it's a broader point, actually. Trade is important. I think trade is beneficial to the world economy. It's beneficial to economies. The UK is a very open economy.
The International Monetary Fund has warned that trade tariffs, reduced migration, tax cuts and spending increases on the scale that Donald Trump proposes would do serious damage to advanced economies. Do you agree?
Well, let's see what he's going to propose.
Do you agree with the principle?
Let's see what he's going to propose.
Well, hang on, we know what he proposes. He proposes all those things.
We don't yet know what he's going to propose as president.
Well, he's president-elect. He's made these promises. Please engage with this.
Let's wait and see. There's a world.
You're dodging the question.
No, I'm not. History would tell us that there is a difference between what politicians say on election campaigns and what they do when they get into office, when they look at the world as they find it. So I'm going to reserve judgment on that.
What Donald Trump does as president has the potential to affect the cost of mortgages on this side of the Atlantic. The bank is hoping that what Trump says and what he does is different. We should too.
Well, Joel's here. So you're outlining the risks, which you've done very clearly, but the bank says there are more cuts to come, just not quite yet.
Yeah, the message couldn't be clearer. It's nudges and winks, but Andrew Bailey basically saying that interest rates will continue to fall gradually from here with a fair wind. Sainsbury's, Marks and Spencer and BT in the last couple of days have all said, Mary, the Chancellor's budget, that's going to push up prices. The bank actually agrees, but not by very much in its view, and certainly, barring something unexpected, not by anything like enough to stop it from cutting interest rates going forward. Now, what happens, though, to the cost of borrowing in the UK will depend to some extent on what Donald Trump does as president. There was a Republican elephant in the room with Andrew Bailey today. He wouldn't talk about it, would he? He refused to offer any view on what Trump's America First agenda would mean for the British economy. And it's quite clear that if we get Trade tariffs of the type that Trump has set out many times during his election campaign, that could damage economic growth. If he does cut taxes and increase spending on the scale that he said he will do, or several times, that's already pushed up the value of the dollar. It's already pushed up the cost of borrowing for the United States government and ours. So there are implications here. The IMF has modelled what Trump proposes, doesn't like it, says it will hurt many countries. The Bank of England, Mary's done something similar, but it isn't going to tell you what its thoughts are. It does point out that Donald Trump is unpredictable, sometimes wildly so, but he also has a mandate to be as bold as he wants.